Thank you. I want to know too.
Yeah,
Thank you.
Get you set up.
All right. Thank you, everybody. Bronson was reminding me that was 5 years ago this month and that I had just had a baby.
Yeah.
And that, of course, you're in the fog of, new parenthood. So my 5-year-old is now starting kindergarten next week. I can't believe it, man.
That was 5 years ago.
Time flies.
You just had the baby.
Yeah, she's cutie. So yeah, while he's firing that up, my name's Anthony Walker, if you don't already know me. I'm actually a Phoebe partner, so I help run the broader organization of Phoebe, along with David Coe and Jeremy Roll, who you probably know better than myself, because they've been around longer than me. Although I've been coming to Phoebe meetings for about 10 years now, and originally met those guys at Phoebe South Bay, met a lot of people, done a lot of business, done a lot of deals, grew my own business along the way. And I'm also the chapter leader for Phoebe Long Beach. So if you want to make a long drive and come down to visit us, I made it today, so return the favor. We meet on the 4th Thursday of every month. So we're having our meeting a week from tonight. And if you want to hear a lot more about all this stuff with the debt markets, right here, there's your QR code, or you can go on Meetup. If you're on the Phoebe Pasadena meetup, it's probably going to try and sell you Phoebe Long Beach and Phoebe South Bay and all that kind of stuff too. So that's a week from tonight down at the Grand in Long Beach. We've always got a great group. It's usually like 50 to 75 people. I've got a really good panel of lending experts from both residential, construction, commercial, multifamily, and we're going to prognosticate on where everything is going in the debt markets right now, because that's the big question mark for a lot of people. I'll moderate that panel. So that should be really interesting. And then we have our inaugural Phoebe San Fernando Valley meeting. Jeffrey, Robert are here in the room. Wave to your adoring fans. Here they are. Yep. Come out and support. I will be there again for another trip to the north side of the Los Angeles area. Yeah. Oh, man. That 5-year-old's wondering where daddy is at home. But it's going to be great. Tuesday, September 19th. QR code for that if you want to register. Come and show your support for those guys. We've got an incredible group there putting that chapter together. We also have Phoebe South Bay. I think they meet on the second Wednesday, right? Down at the Point at the Keller Williams office there at David Coe's office. They do a great job. They're one of the original Phoebe groups. And we're looking at opening a Phoebe chapter in Las Vegas right now. So that's kind of exciting. We're interviewing potential chapter leaders out there. So very cool stuff happening in the Phoebe world. It's lots of fun. So get involved. Thanks to all the volunteers tonight for helping us out. So what we're going to talk about is multifamily investing right here at home in Southern California. Super unpopular topic, I know. I've been going to meetings like this for over 10 years, and everybody wonders what the heck I'm doing investing in California. So that actually makes a great topic of conversation, because the conventional wisdom is, why would you ever buy anything in California if you could buy somewhere else? And I understand that. But the fact of the matter is, people do. Lots of people do. Lots of people make a lot of money doing it, and they've been doing it for decades, including myself. So there is a great value proposition to that, but a lot of people don't understand how that looks. So I thought I would take a little challenge today and see how I could unpack that a little bit, show you how it works, show you some stuff that we're working on right now, some real deals that are either recently closed or in the market, just as a data point. And then a little bit on the economics and stuff like that too. A big part about what we do is market research, so I can share some of that. We did our Phoebe Long Beach meeting last month on our Buckingham mid-year market research update. So that was a super long data-driven presentation, all kinds of stuff in there. If the video is not up on our website yet, it should be soon. So if you want to dig in a lot more on the data side, go check that out. I'm not going to have time tonight to go into all the details on that, because I could spend 2 hours on that alone. But I did bring some stuff from that presentation, and then I have stuff for you guys. Speaking of which, I brought party favors. So we're going to get a little technical. I definitely believe in giving away the real information, not the sugar-coated stuff. If you guys want to help me pass this stuff out, thank you. So these are not flyers for a paid educational program. One side is our most recent quarterly market research from my favorite corner of the market, which is, we call that the Greater South Bay. So that's like LAX down through Long Beach. I know we're at Phoebe Pasadena tonight, and I understand that. We have a whole bunch of the same data from all of the rest of LA, but it's way too big to put on one flyer, and this is where I'm used to talking about. So if you want the stuff from the rest of LA, shoot me an email. My contact information is at the end of this. We're happy to send it to you in Excel format, totally free. We do all this research ourselves, and we correct all the errors in the data. We self-publish it. It's totally different from anything you can get from CoStar or any other data sources. I'll go into that in a little bit of detail. On the other side is a bunch of useful terms and formulas to talk about multifamily. So before I get into the details here, I want to get a sense of people's experience level in the room. Who has invested in an apartment building deal, either passively or actively, before? Okay, awesome. So maybe a third, maybe a half. So I'll cover some super broad strokes basics just to put us all on the same page. If I go too fast or something's really confusing, feel free to stop me. I tend to talk too fast. And I'm happy to explain and dive into a little bit more detail. Also happy to share the presentation with you if you want. By way of a little bit of a further introduction about my own background, you'll notice the Buckingham Investments logo in tiny type here. That's the company that I run. Jeffrey works there, Shirley works there. They're awesome. We are local real estate brokers specializing in investment properties, mostly apartment buildings right here in Southern California. So we've got investors from everybody that's buying their first duplex to house hack to syndicators looking to do a big deal to, I'm working with a large hedge fund that has quite a bit to place. So, and sort of everything in between. And we help investors kind of understand how to make sense of this market, what's going on here, what the value proposition is, what the market looks like. We're all investors in the office ourselves as well, so we're all practicing what we preach. We're not just cold calling desk jockeys. So it's a lot of fun. And we share all this stuff with people just to build goodwill, create relationships in the community, and do that sort of thing. I'm mostly an individual investor myself in apartments. I do a little bit of syndicating, maybe one a year, because clients bothered me so much that they wanted to partner with me on my own deals, so I allowed it to happen. But mostly I just buy stuff for myself. So a lot of the talk you might be used to hearing about, like IRR and waterfalls and stuff like that, we're not going to talk about that tonight at all. This is mostly just going to be focused on like what you would call project level returns on our sample deals, because that's the way that I look at properties when I buy stuff, because I'm not thinking about any of that when I'm buying buildings for myself. So it'll sound a little bit different, and that's sort of what's in our materials. Cool? All right, so here it is. We're towards the northern part of this. We've got the map here with greater LA. Can't really see the relief, but what do you notice when you look at LA on a map? Just broad strokes.
No mountains.
There's not a whole lot of mountains right here, but we're kind of surrounded by mountains, and we're surrounded by ocean, and nowhere else to go, basically, right? We're kind of stuck. So giant city, to be sure, but we're geographically constrained. So we're surrounded by ocean on 2-3 sides, depending how you look at it, and mountains on 2 to 3 sides, and nowhere else to go, with about 10 to 15 million people, depending on who you ask, crunched in there. So when you think about it at a really high level, before we talk about cap rates and prices and this and where everything is going, that's a really good mix if you can buy some of this dirt, right? That tends to work pretty well for people over a long period of time, because artificial supply on constraint. Now that's real estate in general, right? There's only so much dirt in the world, but some of it is definitely easier to come by out in the desert versus right here. And if there's only so much dirt on the supply side, and there's 10 to 15 million people, or 10 to 15 million people on the demand side, that could have some positive implications for people that own some of that scarce supply in this part of the world, right? Now, it's more complicated than that, and it can be difficult to do business here, but at a broad level, this is what makes investing here really attractive if you can find the right properties, find the right areas, and execute. So boiling that down into the numbers a little bit, you might not be able to read this very much, but we're short about 400,000 units right now in the area. Some estimates are way higher, 1 million or more of demand. We've got obviously a huge problem with the housing supply crisis, Big homeless problem. We're all aware of that. We see that everywhere we go. We're trying to solve it through addition of more supply, but that turns out to be very difficult to build in an area like this for a lot of different reasons. Average price per square foot right now, $478 a square foot in LA. Multifamily market, price per unit, $377,000. And total volume, this is from CoStar, $6.6 billion a year in sales. So I don't think $6.6 billion can all be wrong, right? Is that all stupid money, wanting to buy something in Southern California where you just shouldn't buy anything because everybody else is going somewhere else? Probably not. There's probably a reason why all that money is still transacting here and finding a way to do business. So that's what we're going to try and figure out today. Adding to the demand side of the picture, what we have here on the other side is the 2021 gross metropolitan product rankings of world cities. So gross metropolitan product is like GDP for a metro area. This is the most recent. We have data available. I couldn't find it for 2022. And Greater LA came in just over $1.1 trillion a year. So this is the third most productive metropolitan economy in the world, after only Tokyo and New York. I was really surprised that no Chinese cities were on this list. I was actually not expecting that to be the case. I guess because the prices are lower, that's how it goes. But this is what it says. So that's fantastic, right? Again, geographical constraint, incredible amount of demand, huge economy. So it's really popular to say headquarters are leaving downtown Los Angeles, the central business district is on fire, office buildings are worth less than the dirt they're on, we're losing population, and the communists are coming for your properties here. I get it. I have to deal with all that stuff too. But at the end of the day, we have this and we have this. So that's fine. It's a long-term game, right? We're not trying to do anything overnight here. So the result of this over time looks something like this. This is 57 years of property values in that area that you have on your little flyer. This is that greater South Bay market area of LAX down through Long Beach. This is price per square foot on apartment buildings going back to 1965. So in 1965, probably impossible to read from back there, it was $14 a square foot on average to buy an apartment building. This is 2 units and above, so this includes little duplexes and stuff like that. We've been doing this research at our company since 1965. Our company started in 1963. If you're ever down in the Torrance office, come by, you can see we have the old MLS cards on like a brown contact paper box that you can pull out and see the sales from like the 60s and the 70s. It's really cool. We have a little museum. And so $14 in 1965, $518 a square foot in 2022. So this is from our own research. This is a little different than the price per square foot number you saw on the last slide, since that was from CoStar. That skews towards the larger buildings. They tend to ignore the 2 to 4 unit properties, whereas we include all the smaller stuff. And believe it or not, the 2 to 4 unit properties are actually 3 times as many transactions in this area as there are for the big 5 and up stuff. So the numbers are really different from what you might read in news articles or from CoStar or stuff like that, because that's most journalists are pulling their numbers from there, but in reality, it's totally different. If you smooth out this trend, over 57 years, the average annual rate of appreciation on the value of property is 6.5% every year. So that's pretty good. You'll also notice that we do have recessions, recoveries, just like the business cycle, just like the real estate markets everywhere. But every time we have a recession and we recover, we always surpass the previous high. And so if you understand that and you're investing for the long term, you can be pretty comfortable that there's never really an awful time to buy real estate in this market, as long as you can afford to wait and you're never forced to sell. I actually bought my very first investment property in 2006. And I actually I stayed in the business, believe it or not. Sold it 11 years later for the same exact price I bought it for. So didn't do so well on that particular building. But then you know what I did? I kept buying stuff through this and through here too, and that worked out pretty well for me. And I did catch the falling knife for a while. I started getting into multifamily 2009, 2010. The market was in shambles, much worse than it is today. Very hard to get deals done, but I'm really glad I did it, and that allowed me to get to where I am today. So you can get a lot from this chart. I think the main point is, this doesn't look like this everywhere you go. it might look more like a sine wave in areas where that supply and demand disequilibrium isn't as pronounced. It will to some extent look like this anywhere though. Because the great thing about real estate is you're leveraging inflation when you buy property. And so even in the absence of demand-based appreciation, which there's two components to this, there's inflation and demand, you will still experience this to some extent pretty much anywhere you buy. So this is more of a sales pitch for real estate in general. But it's that much more pronounced in an area like LA. I think you would see the numbers would be very similar in New York or maybe Miami or other areas that share a lot of these same characteristics. You'll also notice that it doesn't necessarily equate one-to-one with the stock market, right? We ignored 2001 and kept going up. There we have 2008. We'll unpack this chart a little bit more in detail, especially back here later, because the 1970s were a long time ago. Most of us weren't investing back then. But what we have going on right now in the market is the most similar to what was happening in the 1970s. And very few people remember that. So what we're trying to do, who took finance in school? Couple? Okay. Who's played with a financial calculator in the last month? Okay, awesome. So we have like people that are actually into the real estate here. People ignore this all the time. It's really easy to go online, read some podcasts, listen to some podcasts, not read. Focus on cash flow only and ROI and all this stuff that people teach you about. I'm amazed how few people in real estate education talk about time value of money. People tell you about IRR when they start talking about syndications and stuff like that, which is time value of money, but not the reason, not kind of the foundational stuff behind this equation. So what you're really doing with any investment, this is not unique to real estate at all, is you're playing with the time value of money equation. This is the time value of money equation. So this is the math that's behind a financial calculator, whether you're doing it in Excel or on an app on your phone or by hand or whatever, this is what you're playing with. And so the variables look like this. Your future value, so the value of a sum at a future point in time, is worth the present value, or your initial investment, times 1 plus the rate of return you're able to achieve on the investment to the power of n, where n is the number of years the investment compounds or works for itself. Sounds like a bunch of garbage. But if we graph it out, it makes a little more sense. If we put our money on the y-axis and time on the x-axis, if the folds of the napkin are years, the further you go out in time, this graph accelerates in slope and it goes vertical, because every additional year in n, you have another extra number in the exponent, which means that's the most powerful variable in the equation. So the longer your money can be working for you, every additional year this multiplies by itself again. So by far the most powerful thing you can do is get your money working for you and just make sure it's positive, and you're going to do great, right? Because then you're doing this over a long period of time. The numbers are eye-popping if you play with this with a calculator. It's really inspirational, trust me. So from there, you want to try and get this to go as vertical as fast as possible. That's what R does. So the higher R is, will allow your money, the curve of that graph to accelerate faster. So higher returns means the value of your equity is growing more quickly. And there's trade-offs between risk, return, and where you buy and how you execute and what asset class you're in, and we can argue about that for hours. But this is kind of what's behind all investing. Same thing with money in a savings account, except it's just like this way across the chart. Although right now, actually, savings accounts are not a bad choice. Neither is U.S. government debt. So that's what we're going to play with, right? But with real estate, it's more complicated than that. You've probably seen this before. Stop me if I go too fast here, but you can't just say, I'm going to plop my money into an apartment building or a house or whatever, and I'm going to get R. Because you get R from 4 different elements of return. So R is broken up into cash flow, appreciation, equity buildup through amortization, and tax shelter benefits. Those 4 together equal R. So any investment, you should be able to calculate all 4 elements of return, add those up. That's the R that you actually get on that investment. But each one of these elements of return are useful for different things. So cash flow is very useful for spending on things like daycare and kindergarten and whatever, right? That's what's on my mind right now. Appreciation's great for building equity, building net worth. It's not taxable until you do something with it. And, typically you don't really want to realize the gain. Equity buildup through amortization is the principal pay down on your loan. So if your tenants are paying the mortgage for you, that can be expressed as a return because it's paying off your principal. It's yours. You actually do pay taxes on that amount. And then tax shelter benefits is the quantification of the write-offs or the tax benefits you're getting from owning property. We can complicate the heck out of that another day, but that's depreciation, cost segregation, acceleration, deferral through capital gains, 1031 exchanges, all that kind of jazz. So real estate gives you all of these benefits, and all together they equal this R number. You should be able to get a return between 15 to 40% on a real estate investment, depending on how you're investing when you combine all four of these together. But your choices are wide. So to understand how this fits together, though, you got to get some metrics down. So there's some complicated formulas. They're not that complicated if you work with them a little bit. Who's heard of cap rates and GRMs before? You guys know what this is? Okay. So you have your cap rate, which this is all on that little sheet, which is your net operating income divided by the price or the value of the building. That expresses a yield that the building generates. It's really useful for valuing properties because we can say X building in Pasadena should be a 5 cap, which means whatever the NOI is should be 5% of the value. So I can extrapolate a value if I know the market cap rate for that area. And that allows you to compare markets to each other. It allows you to compare buildings to each other. It allows you to identify a good deal. It allows you to identify value add if you're buying a deal and you're increasing the rents. Same thing with the gross rent multiplier, except that's like a revenue multiple. So it ignores expenses. Cap rate is the net operating income over price, so that's after expenses. GRM is the gross rent multiple, so it's the price divided by the gross income. I personally prefer GRM, even though most people don't. Usually you'll hear cap rate over and over again on at seminars and stuff like that because it's more accurate if you have accurate expense data, but you don't usually have accurate expense data, and not until you're in due diligence or until you've owned a property for a while. So if you're just underwriting a big group of deals and you're trying to understand what might be good, what might not be good, those greedy brokers out there and sellers always try and understate the expenses. So I prefer GRM because it's really hard to fake that. If they understate the rents, you're going to cancel, right? You're going to get the leases, the notices, the estoppels. If the rents are wrong, you're going to negotiate or you're going to cancel your deal. So I prefer GRM. Debt coverage ratio is kind of the critical metric for multifamily underwriting. That's just the net operating income divided by the debt service. And so that's how lenders will size your loan in multifamily. You can't just put 25% down and buy anything you want. You can do that in 2 to 4 units, but not in 5 and up. Depending on how the debt coverage ratio plays out in your deal, your lender will lend you X dollars, such that typically the debt coverage ratio is equal to a 1.2 or greater. That's a bunch of fancy talk for they want you to make 120% of the annual mortgage payments on your NOI for most programs, according to their underwriting and appraisal. So what happens when rates go up? Loan dollars go down. That's what's happening right now. It makes it difficult for people to refinance out of properties. It makes bigger down payments necessary to buy properties. It dislocates the market. And that's what we're seeing in the multifamily space. And it causes all kinds of trouble. You've got your mortgage constant. I probably won't get into a ton of detail on that, but that's the way you can calculate whether you're actually getting positive operating financial leverage on a property and whether you're going to, taking on additional debt is going to improve your cash flow or not. And then there's a leverage factor, which is the inverse of the percentage of equity in a property. So you can multiply that appreciation rate on this chart by the inverse of the percentage of equity you have in a property. If you have 25% equity in a property and the market goes up by 5%, you actually make 20% on your money because it's 5% times 20. There's a leverage factor of 4 at play there because the bank doesn't get to participate in the appreciation, right? So that's a leverage factor. So the more equity you have, your money's getting lazier and lazier, but you're getting less and less risky, less exposed in the event of something going on like what's happening right now in the market. But your returns are going to go lower over a long period of time as you average out these sorts of returns. So most people start with high leverage at the earlier parts of their portfolio, and they scale the leverage down as they start to grow. Cool? Am I going too fast? Questions on this? This is probably like the most important stuff you need to know. Super basic. Yeah.
What was your preference? So you prefer GRM instead of
Cap rate. And I just prefer it because it's less susceptible to subjectivity and manipulation.
And
Mhm.
At the beginning of your presentation, you mentioned why the misnomer or the narrative is no one likes to invest in
Right.
California. You never said why. You just kind of understood that everyone
Sure.
in the space. Can you tell people why you don't like
I mean, the most common talking points you've probably all heard, right? It's a very difficult regulatory environment. Rent control seems to be sprouting everywhere you go. You know, it's tough to be a landlord in California. That's all very real. It's true. It is. Cap rates are higher elsewhere. It's way easier to go buy elsewhere. There's more supply elsewhere. That's not necessarily true right now. That was true a few years ago. My experiences in the right areas here in Southern California, cap rates are better here than they are in many other markets that benefited from that kind of talk over the last 5, 7, 10 years. And you know, we can show you that basically. But that's typically the talking points is, you know, go to the red states, it's easier to be a landlord, all that, right? That's where the job growth is. The U-Haul chart, we've all seen the U-Haul chart. Yeah, I love the U-Haul chart, that's great. We're losing 0.5% of our population right now on a year-over-year basis in the LA area. That's 50,000 people out of like 10 million, right? I don't care. That's cool. There's still $1.1 trillion in gross metropolitan product that is coming into this economy that can rent units that I'm buying below replacement costs for properties that can't be built because of the same regulatory environment at all. That's really great. That works just fine for me. So, you know, it's a more nuanced picture, but great point. Good point. Yes?
Can you explain how you can use GRM, like when you're buying, like if you're buying a single-family house, they kind of take the area
Right.
for the value, but you can kind of use GRM for that.
I'm going to get into that in just a second. Right now, actually. Thank you for the segue.
Sorry, another question.
Yeah.
The ECR and leverage factors, could you talk about that once more, especially the context that you're putting around it? Couldn't quite follow that.
Sure. They're interrelated as well. So first on the debt coverage ratio, that is primarily a commercial loan underwriting concept. That's what the lenders are going to use to tell you what the loan amount is going to be on your property if you're borrowing on a 5-unit and above multifamily, or if you're borrowing on commercial, retail, industrial, or for that matter, owner-user SBA financing uses the same kind of thing. So most commercial real estate finance uses this debt coverage ratio idea. You also hear it called DSCR, debt service coverage ratio, same thing. And so what they're doing is with a residential loan, they'll say, we want your debt to income ratio to be X. Debt to income means they're adding all the income that you have in your life from your job, other investments, whatever, dividing that into your debts, your payments for your whole life, and we'll give you this loan or not. So in that scenario with residential, you're able to use income you get from other sources of your life to qualify for a loan. And as long as your global income is enough, or you have a great job or whatever, you can buy a property at the maximum LTV allowable for that loan program. So typically like a 2 to 4 unit property, that's going to be 75% for your sort of bread and butter, 4-unit loan or duplex loan. Or for a house, it's usually 80%. With multifamily, you can go get a rate sheet from a lender that'll say, yeah, we lend to 75%. And you're like, great, I'm going to go put my 25% down offer, and I'm sure it's going to be fine. But then it says subject to debt coverage ratio of 1.20 or greater. So what that means, if you think about the math here, if your net operating income is $120,000 a year, the lender is only going to loan you enough money such that your annual mortgage payments are equal to $100,000 or less. So if the rate goes up, your loan dollars go down, right? Because then your payments are more for the same $100,000 it's not going to borrow you as much money. And so that affects the leverage that you can borrow on a piece of property. So when rates are at, and there's an interrelation here between GRM and debt coverage ratio too. I have another cheat sheet for that. When rates are at 3.5%, you can buy at 14 times gross with 25% down and cash flow. When rates are at 6%, you have to buy at 11.5 times gross to break even. So back to the GRM question, right? 14 to 11.5, 2.5 multiples of gross scheduled rents, less in price to have the same effect to be able to get the same loan dollars on a percentage basis for that asset. So that's what's happening in our market right now, is because this is getting much harder to hit for people. If those sellers are being stubborn about price, down payments are going up and up and up, and buyers are looking at it and saying, I can't do this. And then it affects the leverage here, because you're getting less leverage. Your leverage factor goes down, which lowers your returns, which makes this not as exciting for everybody, whether you're buying as a passive investor, a direct whatever. So this is across the whole country right now. This is happening everywhere. And so understanding how these concepts all relate to each other is probably the best thing you could do for yourself to really understand not just how multifamily works, but this is all leveraged long-term real estate. Whether you're buying portfolios of homes, retail, industrial, multifamily, whatever, this is pretty much how it all works. It's play with it with Excel sometime, and you'll see what I'm talking about. I'll give you some examples of actual properties here, because it is confusing in theory without seeing some examples. Does that kind of make sense? Yeah. So that's causing us a lot of trouble right now in the market. Okay, so here's our most recent market study from, this is the same that's on your page if you can't read it from there. So we do our own research, like I said. We take the closed sale data from the MLS, and then we have our analysts and interns correct all the errors, eliminate the outliers, calculate the GRM and the cap rate for every sale. We do that, I think we're doing it for every city in LA now. And we've been doing it for every city in the South Bay for 50 years. But LA, we're working backwards on the data right now because the company is growing. This is the South Bay sample. I've got the LA stuff in Excel if you want to see it. It's like, it would cover like 5 screens because there's so many cities. There were 190 sales in second quarter 2023 amongst these cities. Average GRM was 16.7. Average cap rate was 4.1. Average price per square foot was 485. And the price per unit was 450 a door, or 450,000 a unit. And so to the question about GRM, right, and identifying what area might make sense for you or what your building is worth in a different area, this is where this comes into play. So we've done the comps basically for you with multifamily in any city in LA you want. And we have pivot tables that'll drill down to the zip code and it just spits it out. So feel free to use it. And look at the difference here. So Manhattan Beach, who's been to Manhattan Beach? Beautiful, expensive, $5 million gets you a bungalow that's falling apart, right? 24 times gross, that's a good deal compared to most quarters. It's usually 30. 2.7% cap rate, $1,300 a foot, $1.7 million a door to buy multifamily in Manhattan Beach. Now that's only on 3 sales, so like it's not particularly statistically significant. Yes? This is 2 units and above. So this includes 2 to 4 and 5 and up. Yep. We do split it out though, so if you want to see and the split out is, I don't think I included that slide, but that's fascinating. The difference in pricing between 2 to 4 and 5 and up right now is about 3 full multiples of GRM. 5 and up right now is in the mid-13s on GRM. Why do you think that might be? It's 3 times cheaper on a whole year's annual rents to buy commercial right now. If you have a 5 unit right next door to a 4 unit. It's the lending. It's this. This applies in the 5 units and this doesn't apply in the 4 units. And the other thing that's going on in the 4 units is it's all 30-year fixed residential money. So what happened over the last 3 years? Everybody got rates in the 2s and 3s on their 2 to 4 unit properties, and guess who's never selling that 2 to 4 unit property ever again for the rest of their life? All those people, just like what's happening in the single family, right? There's that huge supply constraint in the single family market, inventory problem. We have that in the 2 to 4 unit space right now. There are very few good deals in the 2 to 4 unit space right now. There are great deals in the 5 and up space right now. So if you can get into that little bigger space, you are taking advantage of what's happening in the debt markets right now to get an incredible deal on a little bit larger building. Like you'll literally have a 5 unit that'll go for 1.1 and the 4 unit next door is for 1.5 because the debt is so different. It's really weird. And so then, compare this to some of these other markets. We do a ton in Long Beach, 74 sales, 16 times gross in Long Beach. That goes from Belmont Shore to, North Long Beach where there's a lot of variety in the neighborhood quality there. But you can easily get a deal in Long Beach in the 12s or the 13s on the gross rent multiplier right now. Those are the mid-5s for a cap rate. So that's really good, much better than your overall average here. But this allows you using that concept of the GRM and the cap rate, allows you to compare whatever building you might be looking at. That's cool if you want to buy in Manhattan Beach. just see if you can beat 24 times gross on whatever you're buying, and you probably have a good deal on your hands, right? You might want to get a little more data than 3 sales, but this is how you do the comps for multifamily. So you want a better cap rate than the competition, you want a lower GRM than the competition, right? Because the GRM is like a PE ratio, so you want to pay less per dollar of annual rent revenue. In Manhattan Beach, you're paying $24.30 for every $1 of annual rent revenue. In Long Beach, you're paying $16.30, right? So that's kind of how you do the comps with multifamily. That applies anywhere in the country. This is just how it looks here. Cool thing about our market is we have like everything on the menu from, C areas to A areas. So whatever type of investor you want to be or whatever type of investment you want to get into, you can do it within a 20-minute drive from wherever you are in LA. And there are strategies that make sense for, all of those types of properties. Here's a couple select cities from the rest of LA that I pulled from that larger sheet. So these are just cities that had more than 10 sales last quarter. You'll notice Los Angeles had 329 out of 479 on this slide. And the average GRM is about the same. So the trend follows 17 times gross, 4% cap rate is sort of our overall average. But of those 479 sales, like 75% of those are 2 to 4 unit properties, which I think are selling for unusually high prices right now. Yeah.
In those 2 to 4, are you including ADUs?
Good question. So those will usually stay in the 2 to 4 section. It sort of depends like how they're marked. Not a lot of those have resold yet. So there's thousands of them under construction right now. And so when they get relisted, it sort of depends how people will relist it. So, if it's a 2 plus 1, it's obviously it's a 3, right? If it's a 4 plus 2, it depends how they list it. We would probably put that. You could actually finance those either way. So that's kind of an interesting case study there. That's a nice value. I think that's a great way to add value, but then you're buying a 4 unit anyway and overpaying. So I personally prefer buying like 5 plus buildings and then adding ADUs to those, because I think then you're getting great value. So just some sampling here. These are all in a pretty tight range, but yeah, LA average 14.5 times gross, almost a 5 cap. That's way down. Prices are down, from a year and a half ago. Yes?
Are these all the cities with 10 or more transactions in that second quarter?
Yes, they are. So there weren't that many, really, just in that one quarter. Transaction volume's way, way down. In our market research presentation I did last month, it's at like half of what it normally is right now. It's down to like 2009 levels of transaction volume right now. Everybody's waiting to see what's going to happen. Yeah.
You break down LA into neighborhoods?
Yes.
In your data?
Yeah, we have a pivot table that does. Yeah, obviously that's useless, right? Yeah. So. Yeah, so that you're right, but we made it separate because it's big enough. It has 10 of its own, so we sort of sliced it up where we thought it made sense, because LA is such a weird, it's a hard geography to work with. Yeah, on the Excel. So if you want to manipulate this stuff on your own and play with it, we actually have a market research dashboard. There's a QR code to it. It's free. It doesn't even take your email. We're not going to call you. We might if you give us your business card. But so you can filter and see this. We've got 10 years of data going backwards on the market research dashboard. You can filter for 2 to 4 only or 5 and up only. You can drill down to zip codes. You can look at cities. I think we only have those greater South Bay cities loaded in there right now. We're working on loading the rest of the data in there. So you won't see LA in there right now, but you will see those cities that are on your handout. If you want to play with that and see how the charts go over time and just mess with it, if you go to the advanced drop down on that, you can play with the data and export it into PDF, whatever you want. Just cite us if you use it, please, because it is our research. Okay, so I wanted to talk a little bit about cap rates and what that means and how that all works, because people are super confused about cap rates most of the time. If you listen to a few things, you read a few things about real estate, most people will say, just go find the highest cap rate you can possibly find and buy that one. And yeah, I mean, if it works that way, that's great, because technically you're going to get the highest cash flowing building you can find if you go buy the highest cap rate you can find. And because it's an expression of the yield, you're also buying the cheapest property you can find. But what a cap rate really is, if you think about it, is because that's a market-derived metric. It's an expression of the yield investors are willing to accept on invested capital in that area for that asset class. And it's a market description metric for that reason. So cap rates are low in a given area because that's what investors are willing to pay and accept a yield for in that given area. They're high in another area because investors require a higher yield in that area to buy in that area. Why might that be? Because it's an expression of risk, right? It's just like those of us here, there's a lot of people here who invest in debt, right? So if you're doing hard money loans or second position stuff or whatever, you're probably getting like, what, 13% right now? Or I guess that's even first position hard money is 13% these days, right? So high yield debt investment is what? High risk. But you're getting compensated for the high risk with that high rate. You know, AAA US government debt is at 4.2 today on the 10-year Treasury yield. Relatively high yield compared to what we're used to, but that's a lot lower. Investors are willing to accept that lower yield on government debt because they look at that as basically the risk-free rate. That's the lowest level of risk, but it's super popular. Money piles into government debt because it's low risk. So money piles into Beverly Hills, money piles into Manhattan Beach, wherever, for these super low cap rates because people are willing to put money to work for less risk in exchange for a market cap rate that they think is appropriate for that area. So if you go to a training class or you read a book and somebody says just buy the highest cap rate you can possibly find, you are literally going to buy the most risky deal you can possibly find. Like you could go look on the market right now, you can probably find an 8 or a 9 cap somewhere in LA. Don't buy that building unless you really know what you're doing. It's not going to work out that way on paper. It looks that way when those brokers present it to you, not in real life. So a lot of people don't understand that about cap rates, and you need to understand that in order to make sense of markets and pick where the right place for you to invest might be. For me personally, I like the middle of the road stuff. You know, workforce housing, it's cheaper than they can replace it with for new construction, tons of demand, no competition from new supply, rent growth is great, it's cheap, easy to value add, super basic, nothing to the major systems. That's the type of stuff I buy. My corner of the market is like in the mid-5s on the cap rate right now. That's pretty good. But why would I buy that at all if commercial real estate debt is at 6.5? That's the next question most people ask. Wouldn't you just be doing nothing? I can understand that. If you're borrowing debt at 6.5% and you're placing it into an asset at 5.5, like, you know, the formula should say no deal. Yet we're seeing lots of this stuff happen. So let's look at that over a historical period for a little while. So these are historical cap rates from our research going back to 1965. That's the blue line. And the 10-year Treasury yield going back the same period of time. Again, this is from our research. So these cap rates are going to be lower than what you would see published from CoStar or anything like that because this includes all those 2 to 4 unit properties, which generally have lower cap rates. They're more expensive. And you have the 10-year Treasury above that. So, you know, conventional wisdom or what you would read all over the place right now is, well, rates continue to go up, so prices have to go down more and more. And yeah, that's happening over a short period of time. That's happening right now. Prices are getting hit, especially in 5 and up, because it's difficult to finance them. But that's not necessarily the case on a broad trend, because if prices are going up because of inflation, then other stuff happens. So come back here to the 1970s. And I'm going to take a different chart now. Here's the cap rate versus federal 10-year Treasury yield plus 1.5. What this is approximating what commercial mortgage interest rates might have been at each one of these years going back that far. With residential debt, you can go and just look up, you know, whatever, Fannie Mae 30-year fixed loan rate at any time, and you'll get that historical data. With commercial, the lenders take a different risk appetite every week almost, and so they will increase and compress their spreads or their premium above their risk-free rate. But a good approximation of kind of what commercial real estate debt might have been priced at any given point is usually about 150 basis points or 1.5% above the 10-year Treasury. Yes, sir.
Seems like the trend has been going down for cap rates over the long term.
Definitely.
Why is that?
Because everything's been getting cheap. Rates have been cheap for so long. It's been down and down and down. Tons of demand. free money. And so we've seen this slow march from the last time we were in this sort of situation coming off into the 90s and down and down and down. So as rates go down, cap rates kind of follow them. And this is what I'm saying is as cap rates rise, rates are rising, so cap rates are rising, which hurts value, but it's more complicated than that. So what's happening right now is, look at this. So deals are still transacting, but this 10-year treasury plus 150 basis points is now solidly above the cap rate line. So that's kind of what I was saying at the beginning, like why would people be transacting at all if this is what's going on in the market? It doesn't make any sense. So why are people buying in Southern California? Why are people buying anywhere if this is what's going on? Because it's actually hard to find a cap rate higher than 6.5 in any good, like, tier 1 market right now. And the answer is back here. Look how long that dynamic was present in the market a long time ago. If we go back pre-2000, that sort of ostensible commercial real estate rate was higher than cap rates for 30 years. And nobody remembers that. So all you hear is, well, why would I buy? Why would I buy? Cap rates are too low. They got to come up. And yeah, they're coming up, and they probably will continue to come up for a while. But that was normal for a really, really long time. And I think you can argue a few things on this. It could be normal because I think people are applying what you could call a growth premium to real estate. So if they're willing to buy for a lower yield than their cost of funds, if they think that the asset is going to do more for them than just the yield at the time of purchase. You wouldn't buy a debt instrument with this kind of spread, right? That would just be stupid. But real estate is so much more than like just a yield instrument. Your cap rate is only that cap rate on the day you buy it. As soon as you can raise rents, your cap rate just changed. If you can lower expenses, your cap rate just changed, right? And so people understand that. This started to diverge when? The last time we were going through what we're doing right now. Early 1970s, inflation started going wild. Interest rates started going up aggressively, but cap rates went down. So weird, right? So that's kind of, I personally think the Fed's going to get it under control, and we're not going to see like 20 years of this happening, but it could go that way again. And there is absolutely a sensible case for putting money to work when you have that mismatch going on in the market. So it's weird times, but we've actually been there before, and we've been there for a long time before. So when I look at some of my deals that I bought a while ago, I might have bought a deal at like a 3.5 or a 4% cap rate when rates were really low. I might have owned them a while. I might have raised rents by 50% though, and now I have like a 10 or 11% cap rate on my purchase plus my renovation costs. And that's way more than, I can refi that building at 6.5 and I'm fine. I'm cool. In my head, at least, I can justify it, right? It doesn't bother me so much. So kind of a weird way to look at it. You won't hear people talk about it like this usually. So if we drill into the 1970s and check this out, this is what happened last time we were here. I always like to show this slide. It's hard to see on the 50-year chart, but we went from 17 bucks a square foot in 1971 up to 86 bucks a square foot in 1981. That's a 406% increase or appreciation during that time period, during which interest rates went from 7% to 16%. So this notion that like prices have to dollar for dollar go down every time rates go up is fiction, especially in an inflationary environment right now. Because what's happening is prices for everything are going up, including rents, which is happening right now too, right? So you can have cap rates rising, and they are right now, but when we come back to our chart, what the heck? Prices are still going up. Dollar for dollar, prices are going up. Price per square foot is going up. It went down a little bit in the first 2 quarters of this year. It's down like 8%. But on an income basis, it's down 12%. And the only thing that can explain that is that rents have been rising. Now, rent growth has leveled off a bit. It's not as aggressive as it was, but that if inflation continues to rage, that's what's going to continue to happen. So you can actually have appreciation on the asset itself while cap rates rise, which is counterintuitive. They don't necessarily go together one-to-one.
The other thing with cap rate doesn't take into account appreciation or tax benefits either, right?
No, the cap rate is not, it shouldn't be used as an expression for a return. It should be used to compare a deal to other deals and to give you a general idea of what the dynamic on that deal is going to look like and how financing is going to impact it and how much you're going to be able to borrow and what the risk profile on that deal is. It's not an expression of return. People use it the wrong way all the time. It's a market descriptor metric. You could say, what's the going cap rate in Pasadena? And if you know that, you know what you should pay for a property. Because the total return is that whole other picture altogether, right? So if you want to play around with this on an individual property, we also have we just redid our website. We're very proud. This is free. This one does steal your email. I'm sorry. You'll probably get a call from somebody if you use this, but it is free, and we're really nice. We're not super aggressive. We will only try to sell you an apartment building. So this is our rental property analysis calculator, and you can just enter all of your little statistics on your building. This would work anywhere you want, but be careful. GIGO, garbage in, garbage out. Don't convince yourself it's a great deal and then blame us if you didn't call anybody from our team to vet it and work with you on the sale. But this allows you to put in, purchase price, square foot, all that stuff, and then it'll spit out your cap rate, your GRM, all that kind of stuff on the building that you're looking at. Super simple calculator. I mean, you can get this in Excel anywhere too, but if you want to do it here, feel free. So I know we're running low on time, but I want to show you some real deals that are going on right now to show you that people really are transacting in Southern California. Here's one. This is actually a live listing that I currently have for sale. This is over in Boyle Heights, just east of the Arts District in downtown LA. And this is an interesting property because it's new construction. It was built in 2017, so newer, 6 years old. It also has permits ready to issue plans for 2 ADU studios, these little container homes. They're pretty cool. So you could start construction immediately on this property. And now that we understand the metrics, we have a frame of reference to look at this deal and decide if we think this is good or not, right? So it's priced at $2.65. It's 6 3-bed, 2-bath units. So these are enormous, they have vaulted ceilings on the top units. They're like 1,000 square feet each. They're really nice, in-unit laundry, the works. These are really, really nice units. GRM on actual rents is 12.4. So do we remember what we had on our sheets? Is that good?
Yes.
It's a great deal, right? Cap rate on actuals, 5.4. Good deal, way better than the average. This is even separately metered for water, trash, everything. There's no utilities. The landlord pays it all in this building. GRM on market rents after you build the ADUs is 9.8, and you get a 7.3% cap rate after you build GRMs, right outside of downtown Los Angeles. So these are killer numbers. It's hard to beat those numbers in a lot of markets in the city. So this notion that there's nothing good in California, not true. It's basically 3 duplexes, parking in the back, and then you put the ADUs in between with a crane. That's how it works. So pretty cool deal. That one's actually available right now. Here's what the rents look like. We've got 3 beds going for about $3,000 or so, and then we estimate that the studio ADUs would go for $1,800. You can see some there's really nice units, big vaulted ceilings. You could do Section 8 here and probably get $3,100, $3,200. The ADUs, there'd be about $125,000 a piece, so $250 total. Yeah, so I'll show you that on the next slide. So this is just, the purchase price doesn't include that. You'd have to invest that after. So this is just on what you're buying with the purchase price. That's after spending $250 to get the ADUs there. Here's the financing. We actually have really good debt available on this for 5.75 interest only, fixed for 5 years. And we can go 65% LTV here. So that's unusual. That's another benefit of investing in a tier 1 market is you get better debt terms than anywhere else. And we've got a lot of room on the debt coverage ratio. And then to your question, here's kind of how the returns look if you were to build the ADUs. So this is an interesting deal in that it's kind of new construction, but it also has a value add component to it because you can add more units to it after close. This is how we kind of analyze buildings over a long period of time. Kind of different from what other people would look at. So you have your 4 elements of return: appreciation, cash flow, tax benefits, equity growth. You'll notice the equity growth is 0 because we have an interest-only loan, so we're not paying down principal in this case. You'll notice the stabilized market value is $3.37 million. So that's incorporating the value add from building the ADUs at the same GRM that the property is being sold at right now. So if the property is being priced at 12.5 times gross now, you add those 2 units at 1,800 times 12 times 12.5. The building's worth 3.37 after you buy it and spend $250 building them. If we quantify that forced appreciation in year 1, That's $720,000 plus your cash flow, your tax benefits, and you make about a 65% return on your money in year one. It's a 5-year fixed, but it's a 30-year loan. It just adjusts after 5 years. Yeah, no balloon payment. And then what happens in year two, whatever you set for your appreciation rate takes over. I put 5% on my assumptions for this just to kind of go a little more conservative than that long-term rate of appreciation. And you'll see what happens is your returns then drop as you get deleveraged. So you added all this value here. Your equity jumped from 50 to 53. And now your equity grows, but as your equity grows, your ROE goes down. So typically most investors would buy a deal like this. You probably own it for 5 years or so, 4 or 5 years, and by the time you got 2.2, 2.4 in here, you might exchange, and you go buy something for, $6 million and do it again, something like that. So that's what that's how you kind of grow your wealth here, buying stuff locally. Good example of a pretty good deal.
I'm sorry, we're kind of at time. I know you've got like 400 more slides.
No, we're
here,
done.
but
So
it's
yeah, we
really
can
good.
stop it.
Wasn't that awesome, guys? That's so good.
Thank you.